Hello, my name is Michiel Plakman and I'm one of the fund managers of the Sustainable Global Equity Strategy here at Robeco. So let me walk you through our investment philosophy. Our investment philosophy is really based on the fact that the market is way too short-term oriented. We look for stocks that have high free cash flow generation, high return on invested capital, and good sustainability characteristics. It is important to select stocks that have very good free cash flow generation and good valuation on free cash flow, because free cash flow is the best way to measure the economic value that is added by a company. The value of free cash flow is enhanced by the return on invested capital that a company generates. This is important because companies that are able to reinvest their cash flows against the high return on invested capital also make that cash flow a lot more valuable. Sustainability information is becoming increasingly important in this light as well. Sustainability provides an additional lens to look at companies in terms of their quality. It is not just a measure of risk and another lens to look at the risks of a company, but also to look at future opportunities. We believe this will be increasingly important over time. We have a disciplined investment process with sustainability integrated in every step of the process. We start with a universe of around 2,000 stocks where we use exclusions, then screening, then in-depth research to get down to a portfolio of 25 to 40 names. In the next couple of slides, I will walk you through how we do this exactly. When we start with our investment universe, first we exclude stocks with detrimental business practices. So we exclude the stocks with the 20% lowest Robeco SAM scores. We also apply the Robeco SAM exclusion list and stocks that have an issue or that form an issue with the UNPRI. To give an example, we exclude stocks in aerospace and defense, we exclude tobacco stocks, and there's a number of other categories of stocks that we exclude from the start. Then we use our screening in the second step, where we look at companies that have high ROIC, high free cash flow, good sustainability criteria. So we work down our investment universe of 2,000 names to about 600 stocks that could potentially be of interest. In our weekly meeting, we sit down with all our PMs and analysts and discuss the names that could potentially improve the portfolio overall. The portfolio is a competition for capital, which means that a name has to add something to the portfolio and has to materially improve the portfolio from a free cash flow, a ROIC, or a sustainability perspective to actually be considered a candidate. That's when we start our research in a particular name. During every weekly meeting, those names are then discussed, and at the end, the fund managers, Jan Kuppens and myself, make a decision on whether to change a name into a portfolio or to add a name to the portfolio. In the end, this results in a portfolio of about 25 to 40 names of the best ideas on a global basis. And currently the portfolio has 36 names. When we've selected an idea that in the end could make it to the portfolio, we start our deep fundamental analysis on the name. So we write a detailed investment case that highlights the fundamental strengths and risks of a company. We look at the secular drivers or secular growth drivers that may affect the company in the long run, both from a positive as well as from a negative perspective. We look at the sustainability factors that affect the company, both in a good and in a negative way, and we make a detailed valuation model of the company. Ultimately, we try to get a feeling for the value drivers for the company and determine a price target that we think could be reached within the next 12 to 36 months. So all stocks are selected with a horizon of 36 months. For each of the stocks that are candidates for the portfolio, we build a detailed valuation model. Here we look at the drivers of economic profits for a company. So we look at how a company makes its money, what the top line growth could be, the margin structure, the invested capital needs, invested capital turns, and of course the cost of capital. What is important is that in this part of the analysis, we look at how the sustainability factors might affect each of the economic drivers for a particular company. In the end, the aim of the exercise is to generate a target price that we think could be reached within 12 to 36 months. Based on the upside that a particular company has, we rank the stocks according to our preference and then decide whether it makes it into the portfolio or not. Now I will hand over to my colleague Chris, who will explain the integration of material ESG factors in our investment process.
Hi there, my name is Chris Berghouwer and I'm one of the portfolio managers of the Sustainable Global Star strategy. My responsibilities within the team are to cover alt economy sectors such as energy, materials and industrials. And I'm also the head of ESG within the team. So instead of focusing only on one particular factor in the investment process, it's really about the combination of both financial and material ESG factors that provide the setup for outperformance. So in other words, we strongly believe it's the combination of our quality focus and our advanced ESG integration in a high conviction strategy that leads to the best opportunity for alpha generation. Sustainability is truly embedded into our process and goes far beyond a box ticking exercise. For example, our strategy not only looks for companies with a strong sustainability angle, we also aim to have a low environmental footprint. And in some cases, we also do negative screening or even exclusions of companies that do not fit our ESG strategy at all. However, we actually prefer to always first actively engage with a company and have an open dialogue with management whenever we see room for improvement on ESG related issues. All in all, the way we integrate ESG is one of the most important drivers behind our resilient performance and proven track record of alpha generation. Let's now focus on how we do ESG in practice. So every analysis starts with a three-step process. In the first step, we identify the most material ESG factors. So we really only focus on those factors that are financially material to a company. Secondly, we try to analyze the potential impact of those factors on the company's business model. And finally, we try to quantify this impact by adjusting the value driver assumptions in our valuation model. All of this is done in close cooperation with the sustainability analyst of Robeco, Sam, who together with the fund manager work in a parallel track. So we have a constant feedback loop on how ESG really impacts valuation and ultimately hits on our investment decision making. So not all ESG is equally important. So in order to find out what the most material ESG factors are for a particular company, in this case a large software company, we use various tools. One of them is called the ESG dashboard and is really a bottom-up tool and focuses on company-specific factors. And those factors can either show up as a green or as a red flag and then require further attention. The second tool is called the materiality framework and is more a top-down tool of identifying what the most material ESG factors are for a specific industry. Together, both tools provide a good starting point on what to focus on. So in this example of the software company, we know that we need to further zoom in on issues on human capital management, corporate governance, and innovation management. Over the years, we've written over 200 investment cases, and in roughly half of which we adjusted our valuation model and therefore impacted our buy and sell decision making. As the Sustainable Global Star strategy focuses on quality companies with a strong sustainability profile, it therefore makes sense to see a tilt towards positive adjustments. as this really reflects the opportunity side of ESG. This also ties in with our earlier research that suggests that good performance on financially material ESG factors marks a high-quality company. This reinforces our view that ESG information helps us build conviction in our portfolio decision-making process. We have always integrated sustainability into our investment process, but since a few years, we are also actively tracking the ESG attribution to our investment performance. And it turns out that it explains about 20% of the excess return generated over the years. Most of this excess performance due to ESG comes from our bottom-up integration of ESG. Next to that, we also found that the exclusion of sectors such as tobacco and aerospace and defense have a net positive contribution to our investment performance. Moreover, it seems ESG factors also have proven to become even more important in volatile markets, such as in this current COVID-19 crisis, where ESG tends to act as a performance cushion in order to avoid downside risk. Overall, we clearly see that ESG improves the risk-return profile of the Sustainable Global Star strategy. So this concludes our session on Sustainable Global Stars. And if you have any further questions, please feel free to reach out to us. Thank you.